Welcome back to Accounts Decoder. Today we are tackling a more advanced but super important topic in accounting: recording finance lease transactions. This isn't your regular rent. A finance lease is more like a buying an asset on credit. You are not just using it, you are assuming the risk and reward of ownership. So, how do we account for it? At the start of a finance lease, you recognize both an asset and a liability on your balance sheet. The asset represents your right to use the leased item, and the liability reflects your obligation to make lease payments. You measure both at the present value of future lease payments. Here's the initial general entry: debit right of a used asset, credit lease liability. Now, every month you will need to make two entries. First, to depreciate the asset over its useful life, and second, to recognize interest on the outstanding lease liability, just like a loan. Let's walk through a simple example. Suppose your lease machinery worth 5 lakh over 5 years with the monthly payments at anticipates your record. Debit right of use asset 5 lakh, credit lease liability 5 lakhs. Next, each month you will record depreciation. If it's a straight line over 5 years, debit depreciation expense 8,333, credit accumulated depreciation 8,333, and let's say the monthly interest on the lease liability is 2,000. Then when you make the payment of 10,000, your entry is debit interest expense 2,000, debit lease liability 8,000, credit cash 10,000. This way, your books reflect the true cost of using the asset along with the repayments of the lease liability and interest. To recap, for a finance lease, you recognize a right of use asset and a lease liability upfront. Then each month you record a depreciation